Welcome to the research desk. Imagine looking at two completely different screens to understand the state of the world today. On the screen to your left, you have your financial terminal, right?
Yeah, the one showing the endless green arrows.
Exactly. Your retirement account is hitting unprecedented all-time highs. The stock market is moving with a velocity and honestly a confidence we have rarely seen. It's driven by these trillion-dollar technology monopolies that are literally building the architecture of an artificial intelligence future.
It looks like an absolute economic triumph from that vantage point.
It really does. But then on the screen to your right, you have the actual ledger of everyday economic life. Your grocery bill has effectively doubled over the last few years. The prospect of buying a house feels like a mathematical impossibility for the median wage earner.
Oh, absolutely. Local businesses in your community are struggling to secure credit, and the public mood is just decidedly, stubbornly sour.
Right. So today, we are attempting to answer one incredibly complex question. Which of these screens is lying to us? We're examining the profound and widening chasm between triumphant stock market indices and a strained, increasingly fragile macroeconomic reality.
And that chasm is precisely where the danger lies. We are constantly told by financial media that the stock market is a discounting mechanism, right? A barometer for future economic health. But when the barometer reads clear skies while the actual populace is drowning, we really have to question the instrument itself.
Well, the central tension we have to resolve today is not simply whether one side of this equation is technically incorrect. That would be too simplistic, I think. The real question is whether financial markets are correctly pricing a genuine AI-driven productivity regime shift, one that is fundamentally rewriting the laws of economics.
And this is my view, whether these markets are merely floating on a levitating bubble of post-2008 liquidity, mega-cap concentration, and narrative momentum until gravity finally returns.
Right. And my perspective, the case I'll build today, is that Wall Street is rationally discounting a new technological reality. We're witnessing an economic transition characterized by zero marginal costs, software-based distribution, and massive returns on capital. The reality is that legacy Main Street metrics fundamentally failed to measure this new reality. The market is not wrong. The old measuring sticks are entirely obsolete.
I come at it from a completely different way, as you know. What we are observing is not a permanent new plateau of productivity. It is a precarious state of pseudo-stability. We are living through the consequences of an unprecedented flood of central bank liquidity that is pooled into a remarkably narrow set of superstar firms.
You see it as an extractive ecosystem.
Exactly. It creates an extractive economic ecosystem that masks deep structural fragilities and stagnant broad participation. The headline wealth you see on that left screen is largely an illusion. It confuses the exceptional, highly specific economics of a few compounding balance sheets with the holistic health of an entire society.
Okay, to untangle this, we can't just rely on theory. We must establish the statistical facts on the ground, because the severity of this disconnect is mathematically undeniable.
Let's hear the numbers.
So we can anchor our discussion in a baseline statistical triad that proves just how far asset prices have outrun the underlying productive participation of the real economy. First, we have the market cap to GDP ratio, which is commonly known in financial circles as the Buffett Indicator.
Right. Warren Buffett's favorite metric.
Yeah. In 2023, this metric sat near 190%. Let's be really clear about what that means. Historically, Buffett and other value investors considered anything over 100% to be overvalued. The logic is simple. The total value of the stock market should roughly track the total output of the national economy.
Which makes intuitive sense.
Right. So to have this ratio approaching 200% suggests a near-total decoupling of equity valuation from the actual physical economic output of the nation.
That alone should give any rational observer pause. When the total capitalized value of corporate equity is almost double the gross domestic product, you're no longer investing in the current economy. You are investing in a heavily leveraged expectation of a flawless future.
Exactly. And that leads to the second metric in our triad, the valuation of those earnings. We're looking at a trailing S&P 500 price-to-earnings ratio of 25.1.
That is incredibly steep.
It is. The trailing PE simply measures what investors are paying today for the earnings companies generated over the past 12 months. A 25.1 multiple indicates investors are paying a steep, historical premium for every single dollar of corporate earnings. And third, and perhaps most critically for your argument regarding the real economy, the labor force participation rate remains stubbornly stuck at 62.8%.
I want to focus on how those three numbers interact, because I agree completely that they do not describe a synchronized, broad-based economic boom. When you have a Buffett indicator pushing 190% and a trailing S&P PE of 25.1 alongside a labor force participation rate of 62.8%, you're looking at a mathematical portrait of asset inflation running far, far ahead of broad economic absorption.
The wealth is decoupled from the workers.
Exactly. The wealth is being capitalized, but the human beings are not participating in the production of that wealth. However, I want to establish some crucial common ground here before we get too adversarial.
Sure, let's hear it.
I agree with you that the technology driving the upper echelon of this market is absolutely real. It is not vaporware. We are not reliving the mania of the late 1990s, where companies were going public with a .com suffix, a Super Bowl commercial, and zero revenue.
Oh, definitely not.
Right. The leading artificial intelligence and platform firms possess extraordinary operating margins. They generate massive free cash flow, and they possess highly defensible economic moats. Software replication at near zero marginal cost is a real phenomenon that generates legitimate, unprecedented wealth.
That common ground is vital. The foundational assets are real. Furthermore, I believe we share the understanding that post-2008 monetary policy and the meteoric rise of passive investing flows have structurally altered how capital transmits from Wall Street to Main Street.
Yeah, the plumbing of the financial system has completely changed.
Exactly. But to illustrate exactly how these forces interact, where real revolutionary technology meets the unforgiving mechanics of market valuation, we have to examine the trajectory of meta platforms. This is a story that perfectly encapsulates the tension between digital scale and financial reality.
Oh, the 2021 to 2022 whiplash.
Yes. In 2021, Meta presented what appeared to be the absolute cleanest illustration of unstoppable digital dominance. You had a platform with billions of daily active users.
The narrative at that time was completely intoxicating for Wall Street.
It really was. The prevailing narrative was one of infinite long-duration growth. Investors were entirely willing to pay premium multiples because the underlying assumption was that Meta's core digital advertising engine, combined with its ambitious pivot toward virtual environments, would simply expand indefinitely.
And crucially, the market assumed this expansion would happen without meaningful capital constraints. Money was cheap, and digital land grabs were rewarded.
Right, but that setup perfectly frames the immense tension that followed. Because in 2022, the macroeconomic environment shifted violently beneath our feet. Inflation spiked, and the Federal Reserve responded by aggressively raising interest rates.
Now, we really have to explain why that matters to a technology company. When interest rates rise, the discount rate applied to a company's future cash flows also rises. If a company promises to make $1 10 years from now, that future dollars were significantly less today if I can earn a guaranteed 5% on a government bond right now.
It completely changes the math.
It does. The higher the rate, the heavier the penalty applied to long-duration growth stocks. Simultaneously, the actual business fundamentals hit a wall. Post-pandemic consumer behaviors normalized, and digital advertising growth slowed.
And Apple introduced those privacy changes that crippled Meta's ad targeting efficiency.
Yes, suddenly the market, which had previously given Meta a completely free pass on massive capital expenditures for virtual reality research, abruptly demanded strict operating discipline.
And the payoff to that tension was historically severe. It was a bloodbath. Meta lost roughly $800 billion in market value from its 2021 peak to its 2022 trough.
$800 billion?
Think about the scale of that number. $800 billion. It was a staggering destruction of market capitalization, practically unparalleled in corporate history for a company that was still fundamentally profitable, still generating cash, and still servicing billions of users every single day.
Which brings us to a critical takeaway, and what I consider to be our first foundational analogy. Technology does not abolish gravity.
Okay, explain that.
Well, the underlying digital franchise at Meta was entirely real. The billions of daily active users, the dominant position in global communication, the highly sophisticated algorithms, all of that was factual. But that technological reality still had to reconnect with the mathematical reality of cash flow, interest rates, and capital discipline.
Right, they couldn't just spend infinitely on VR headsets.
Exactly. Technology can absolutely justify premium valuations over traditional industrial firms. A software company should trade at a higher multiple than a steel mill. But technology does not grant immunity from the fundamental laws of financial physics. When liquidity dried up across the broader economy and the narrative of infinite growth cracked, the $800 billion wipeout proved that gravity always returns.
Because cash is ultimately king.
Yes, no matter how incredible the code is, an asset is ultimately only worth the present value of its future cash flows.
I accept the premise of your analogy, but I draw a completely different conclusion from it. The survival and the subsequent massive resurgence of Meta actually fortifies the broader argument for why these elevated valuations are mathematically justified in the long run.
How so?
Well, they cut costs, refocused their capital, and the stock roared back. The physics of the economy's most valuable layer have fundamentally changed, and Meta proved they belong in that layer. The issue is that we are attempting to measure a 21st century digital economy with 20th century industrial tools.
You mean the legacy metrics?
Yeah, let's think about those legacy Main Street indicators. Economists and analysts are constantly tracking store openings, factory payrolls, inventory turns, and local bank lending. They look at a decline in regional manufacturing and declare the economy is faltering. But those proxies entirely fail to capture the value of global scalability, software-based distribution, and network effects.
So you believe the measuring tools are broken and not the market itself?
Precisely. Value today is intangible. It's encoded in algorithms, data centers, and user habits, not in brick-and-mortar storefronts or steel inventories. Consider Microsoft as the prime example of this new physics.
Okay, let's look at Microsoft.
We're currently looking at a company trading at 30 to 35 times earnings. Traditionalists, especially those trained in old-school value investing, would call that undeniably expensive. They would argue it leaves no margin of safety.
Because historically, 30 to 35 times earnings is priced for absolute perfection.
Exactly. Yet Microsoft is sustaining double-digit revenue growth while simultaneously maintaining operating margins above 40%. I want listeners to really absorb that number. In a traditional industrial framework, an operating margin above 40% at a trillion-dollar scale is almost unimaginable.
Right, Ford or General Motors fight tooth and nail to maintain single-digit margins.
Exactly. I argue this is not irrational exuberance. It's the market efficiently capitalizing superior efficiency, durability, and a competitive moat that deepens every single time a new massive enterprise integrates its operations into Microsoft's cloud and AI architecture.
That is an incredibly seductive argument. But you know, the problem with invoking Microsoft's 40% margins as proof of systemic health is that it treats those margins in a vacuum. It isolates them from the broader economic ecosystem that must ultimately fund those revenues.
But those margins are real cash.
Yes, but Microsoft's revenues are an expense on the income statement of thousands of other businesses. But before we explore that systemic fragility, I want to directly address the absolute purest manifestation of your technological repricing theory, which is NVIDIA.
Ah, yes, NVIDIA is the ultimate test case for this debate.
It really is. If we look at the historical valuation of NVIDIA, the setup reveals a fascinating shift in market perception. Let's go back just a bit. In 2015, NVIDIA traded at a relatively standard price-to-earnings multiple of roughly 25 to 30 times.
Which was completely normal for a chipmaker.
Exactly. At that time, it was viewed by Wall Street as a highly successful but ultimately cyclical semiconductor company that primarily served the video gaming market and some specialized professional visualization markets. When gamers needed new graphics cards, NVIDIA did well. It was a hardware company, subject to the traditional boom and bust cycles of inventory and consumer demand.
But fast forward to early 2024, and the tension in that valuation framework became absolutely spectacular. The multiple expanded violently. It went to 70 times trailing earnings, and at times it spiked over 100 times earnings.
100 times trailing earnings for a hardware manufacturer?
Right. To a traditional industrial investor or a classic value investor trained in the lineage of Benjamin Graham, a multi-trillion-dollar valuation on what looks like a hardware manufacturer trading at 100 times trailing earnings looks like pure, unadulterated mania. It looks exactly like the peak of a speculative bubble that must inevitably collapse under its own weight. It looks like Cisco in the year 2000.
Exactly. And yet, the payoff in the underlying fundamentals presents a formidable, intellectually rigorous challenge to the pure bubble thesis. When you actually open the financial statements, NVIDIA was delivering gross margins above 60%.
Staggering numbers.
And they return on invested capital, the critical metric measuring how efficiently management uses cash to generate profits, frequently printed above 30 to 40%. More importantly, to your point about intangible assets, they possessed an almost impenetrable competitive moat. This moat wasn't just the physical silicon chips, it was rooted in their CUDA software ecosystem.
We need to explain CUDA because it is the absolute linchpin of the bull case. CUDA is a parallel computing platform and programming interface that NVIDIA developed over a decade ago. They effectively subsidized university researchers and early AI developers to learn how to program on NVIDIA hardware using CUDA.
It was brilliant foresight.
It was. Over the years, entire generations of data scientists built their models, their research, and their infrastructure on this specific software language, which only runs optimally on NVIDIA chips.
It is the ultimate lock-in. Switching away from NVIDIA hardware means rewriting years of foundational software architecture.
Which provides the punchline to the NVIDIA story. It is not a speculative shell company trading on a distant promise of future monetization. It is not a dot-com era pet food website. It is an unusually powerful toll booth on a secular platform shift.
A toll booth is a great way to describe it.
When a company achieves a 30 to 40% return on invested capital while effectively holding a monopoly on the computational infrastructure required for the next industrial revolution, capital should flood into it. It would be inefficient if it didn't. This is the essence of capital allocation defense. We are witnessing Schumpeterian creative destruction functioning exactly as intended.
Let's unpack Schumpeter for a moment, because it's a heavy term. Joseph Schumpeter was an economist who argued that capitalism operates through a process of creative destruction, that constant innovation dismantles old industries to make way for the new, more productive ones.
Right. And applying that here, capital must organically migrate away from traditional manufacturers or legacy retailers that are struggling to hit a 10% return on capital. The system demands that this capital flows aggressively toward cloud platforms, semiconductor designers, and AI infrastructure generating 40% returns. The stock market is supposed to be ruthless in seeking efficiency. It is starving the low-margin past to feed the high-margin future.
That is a pristine, textbook defense of market mechanics. But I have to challenge the human reality of that mechanism. If capital allocation is genuinely so flawless, so perfectly efficient, why is the resulting prosperity so intensely concentrated? Doesn't the business model predicated on zero marginal cost software inherently break the social contract of broad-based wealth distribution?
How so?
Well, let's think about the industrial era you are so quick to dismiss. When a car manufacturer in the 1950s or 1960s achieved massive scale and high returns on capital, the physical nature of their product necessitated a specific economic ripple effect. They had to build more physical factories, they had to hire tens of thousands of middle-class workers.
You're talking about the supply chain multiplier.
Yes, they enriched a vast, geographically diverse supply chain. Steel producers, rubber manufacturers, local logistics companies, even the diners and housing developments that sprung up around those factories. The wealth inherently trickled down through broad payrolls and physical expansion. The capital allocation process lifted an entire geographic region.
And you are arguing the digital equivalent does not do that.
It structurally cannot do that. Today, when a software or AI firm achieves massive global scale, it requires a fraction of the human capital. The marginal cost of distributing a software update to 1 billion users is effectively zero. Therefore, the financial returns generated by that scale accrue almost exclusively to a tiny, narrow cohort. Elite software engineers, early venture capitalists, and the passive index fund holders who mechanically buy the stock. The brilliant efficiency of the capital allocation you are praising is precisely the mechanism that accelerates extreme societal inequality.
You frame that concentration as a catastrophic failure of the system, a breaking of the social contract. But I frame it as the market correctly anticipating the future of value creation long before Main Street realizes what is happening. It is not the market's job to manage social policy, it is the market's job to price reality. And Wall Street consistently sees the future before the median consumer or legacy policymaker does.
You think Wall Street is that prescient?
I do. And to understand this dynamic, we need to look at the evolution of Netflix, which proves this foresight flawlessly. The setup begins with Netflix operating as a physical DVD by mail company. Their core competency was essentially logistics, managing inventory and moving millions of little plastic discs through the postal service.
Right, the red envelopes.
Exactly. And the tension emerged as management deliberately cannibalized that highly profitable logistics business to evolve into a digital streaming platform. During that brutal multi-year transition, their valuation looked completely excessive, even absurd, to traditional investors who were entirely anchored to old media economics.
Oh, the legacy media analysts looked at Netflix and scoffed.
They did! They saw a company with no physical studio lots, no dominant regional cable bundle monopolies, and none of the traditional tangible assets that historically defined value and safety in the entertainment industry. They thought Netflix was burning cash to chase an unprofitable pipe dream.
They were pricing them based on physical assets.
Yet the payoff was total, undeniable victory. Netflix won specifically because it leveraged an asset-light distribution model paired with software-driven personalization. They realized before anyone else that global broadband penetration had effectively reduced the marginal cost of content distribution to absolute zero.
You encode a movie once, and 100 million people can watch it simultaneously.
Without manufacturing a single piece of plastic. The punchline here is vital for our broader debate about the current market. The stock market's initial disconnect, awarding Netflix a massive valuation premium, while legacy media giants traded at low multiples, was not a speculative bubble. It was profound, accurate foresight. The market understood that software economics would obliterate legacy physical distribution, and it priced that reality years before it became obvious to the broader public sitting at home.
Okay, I accept the history. The market demonstrated exceptional foresight regarding Netflix's specific business model. But I am going to use your own argument against you right here to pivot our focus from the corporate spreadsheet to the actual street.
All right, let's hear it.
If the market is so prescient, if it is this perfect, omniscient discounting mechanism of future realities, why are the median economic metrics for the actual citizens of this economy flashing bright red? If this technological revolution is so genuinely wealth-creating, why does the broader populace feel so incredibly strained? Why are they angry?
You're pointing to the sentiment surveys.
I am pointing to the reality. This leads us to our second key analogy, which is perhaps the most important concept we will discuss today. The index is not the market, and the market is certainly not the economy. You are pointing to the absolute apex predators of the S&P 500 companies like NVIDIA, Microsoft, and Netflix, and you are conflating their operational triumph with national economic health. To truly understand the illusion of headline wealth on that left screen, we must unpack the income paradox on the right screen.
Well, I am intimately familiar with the income paradox, and I know exactly the data points you are going to leverage to make your case. You're going to point out that median household income rose nominally over the last 2 decades.
I am.
You will cite that it went from $42,148 in the year 2000 to $50,233 in 2007, right before the financial crisis, and eventually reached $74,580 in 2023. And then you will argue that while the nominal trajectory looks positive on a chart, it is entirely insufficient to maintain a middle-class standard of living.
Because it is. It's much worse than insufficient. It is an absolute statistical illusion when placed in its proper macroeconomic context.
Yes, wages went from roughly $42,000 to $74,000, but those nominal gains over more than 2 decades have been entirely, relentlessly consumed by structurally rising living costs.
But we have cheap consumer goods.
And I am not talking about discretionary spending, like flat-screen televisions, which have undeniably gotten cheaper. I am talking about the non-discretionary arenas of housing, healthcare, childcare, and higher education, the foundational building blocks of a stable life. The cost of those core necessities has compounded at a rate that vastly outpaces that wage growth.
So the purchasing power is effectively negative.
Exactly. Furthermore, this nominal wage growth masks severe underemployment and the deep fragility of household balance sheets. We have a workforce dealing with gig economy instability, historically high consumer debt burdens, and a diminished societal safety net. So while the S&P 500 celebrates the incredible margin expansion of a few tech monopolies, the median household is running on an economic treadmill that is accelerating faster than their wages can ever hope to match. They are exhausted, not enriched.
Okay, but how does that tie back to the stock market valuations?
Here's the critical pivot. This divergence is not merely a story of technological displacement or software efficiency. It is overwhelmingly a liquidity story. We cannot have this debate without examining the liquidity deluge. Let's look at the United States M2 money supply, which is a broad measure of cash, checking deposits, and easily convertible near money.
The fuel for the fire.
Exactly. In 2007, prior to the Great Financial Crisis, M2 stood at about $7.3 trillion. By 2023, following years of quantitative easing, zero interest rate policies, and pandemic-era fiscal stimulus, M2 had skyrocketed to roughly $20.8 trillion.
That is a massive injection.
That is an increase of about 185%. We effectively flooded the system with new currency. We have to explain the mechanism of quantitative easing here. When the Federal Reserve buys bonds to suppress interest rates, they push cash into the financial system. Institutional investors, unable to get a safe yield on bonds, are forced to push that cash out onto the risk curve. They have to buy equities just to generate a return.
And you will map that almost directly to the inflation of equity markets.
Because the math is undeniable. Over that exact same time frame from 2007 to 2023, the S&P 500 market capitalization rose from about $13.5 trillion to around $40 trillion. That represents an increase of roughly 196%.
Wow. So 185% versus 196%.
Do you see the symmetry? A 185% increase in the money supply and a 196% increase in the broad market capitalization. The expansion of the stock market is essentially a mirror image of the expansion of fiat currency. This proves that the towering market valuations you are defending are not purely the result of zero marginal cost software efficiencies. They are heavily, artificially distorted by the sheer volume of fiat currency pushed into the financial system by central banks.
But that liquidity isn't evenly distributed.
No, and this brings us directly to the concentration crisis. Because this $20.8 trillion in liquidity did not disperse evenly across the American economy. It behaved like water finding the path of least resistance. Crucially, the top 5 firms' share of total S&P 500 market cap rose from roughly 10% in 2007 to about 25% in 2023. 1/4 of the entire market value of the 500 largest American companies is now consolidated in just 5 corporate balance sheets.
I do not dispute the concentration, nor do I dispute the massive expansion of the M2 money supply. Those are facts. But before we diagnose that dynamic as a terminal disease for the broader economy, we must acknowledge the mechanisms of private credit, which massively complicate your narrative that capital is purely trapped in the top 5 public mega caps.
How does private credit change the picture?
Well, you paint a picture of a starved Main Street. But global private credit assets under management grew from roughly $0.3 trillion in 2007 to about $1.5 trillion in 2023. That is a 400% increase in capital residing outside the traditional heavily regulated banking systems. This is a vital nuance. It suggests a massive, highly aggressive pool of liquidity is actively seeking yield and funding growth in the middle market and beyond, entirely bypassing the public stock market.
I see why you point to that 400% increase. But a jump in private credit does not mean what you imply it means. The expansion from $0.3 trillion to $1.5 trillion did not result in an abundance of cheap, accessible capital for local machine shops, family-owned restaurants, or regional manufacturers trying to modernize.
It had to go somewhere.
It did. But that massive wave of product credit migrated almost exclusively towards sophisticated borrowers, specifically private equity-backed leverage buyouts, enterprise software roll-ups, and large-scale infrastructure projects. It made capital incredibly plentiful in aggregate, but brutally selective in its distribution. It funded financial engineering rather than localized productive capacity.
So you're saying it ignored traditional businesses?
Completely. Private credit operates on demanding strict debt service coverage ratios that require highly predictable recurring revenue. If you don't sell a software subscription, they aren't interested. To understand how extractive this architecture truly is, we must look at the hollowed-out local economy. This dynamic is perfectly encapsulated by the story of a firm we'll call Ohio Robotics.
Let's explore that. Tell the story of Ohio Robotics.
The setup begins with a small, highly innovative robotics company based in Ohio. They developed genuinely promising physical industrial automation technology. They possess brilliant engineers, tangible prototypes, and a product that could significantly improve regional manufacturing efficiency. They are exactly the kind of company you want in a healthy industrial ecosystem.
Sounds like a perfect growth candidate.
Right. The tension arises when they attempt to scale their operations. They need capital to build a production facility, but they struggle to secure favorable growth financing from local community banks, which have largely been consolidated out of existence over the last 2 decades. So they turn to this supposedly abundant $1.5 trillion private credit market you just mentioned.
And I'm guessing they get rejected.
They are completely ignored. They are rejected because they lack the recurring software-as-a-service revenue profile that private credit demands. They are hardware-heavy, they are capital-intensive, and they carry execution risk.
And so the payoff inevitably is that they are forced into an acquisition.
Yes. The payoff is they run out of runway and get acquired for their intellectual property by a massive, multinational tech platform based on the West Coast. The acquiring platform extracts the core patents, integrates the software algorithms into its global stack, and immediately shifts the physical production of the hardware to an established overseas supply chain to maximize margins.
And the local community is left behind.
Exactly. The punchline is devastatingly clear. The West Coast acquirer stock rises on the news of a synergistic, forward-looking acquisition. The headline index hits a new all-time high. But the local employment multiplier in Ohio completely vanishes. The community loses the high-paying engineering jobs. The local caterers, the cleaning services, the secondary suppliers all lose a client. The regional tax base erodes, and the downstream economic velocity simply ceases. The value creation is technically real on a Wall Street spreadsheet, but the value distribution is entirely extractive. It pulled the genius out of the soil and left the community barren.
That's a grim picture.
This is why history provides such terrifying anchors for a current moment. When we look at 1929, we see a textbook example of financial exuberance, driven by margin debt and new technologies, like radio and electrification, completely outrunning aggregate consumer demand. The structural foundation was weak, but the apex was dazzling.
And 1999?
When we analyze 1999, we see a period where a genuine technological paradigm shift, the build-out of the internet, coexisted with wildly unsustainable speculative valuations that eventually collapsed and took years to recover. And when we study Japan's lost decades starting in the early 1990s, we learn the most sobering lesson of all. Immense technological sophistication, incredible robotics, and globally dominant export firms fail entirely to prevent structural economic stagnation when a massive asset bubble bursts against the backdrop of a demographic decline. You can have the best technology in the world, and your economy can still flatline for 30 years.
Those historical anchors are dramatic, and Japan is always the ultimate cautionary tale. But I must push back fundamentally on your framing of the Ohio robotics story and the liquidity argument. Are you just nostalgic for industrial-era employment?
It's not nostalgia, it's about structural stability.
But you are lamenting the loss of a specific type of localized, geographically bound manufacturing job, while completely ignoring the macro efficiency gained by integrating that automation IP into a global platform that can deploy it at scale. By acquiring that tech, the larger firm might reduce supply chain costs globally, which eventually lowers prices for consumers everywhere. Furthermore, if this is purely a liquidity bubble, as you assert with your M2 chart, why did the $20.8 trillion in money supply pool specifically in companies generating 40% operating margins rather than dispersing equally across all asset classes?
Because that's where the narrative momentum was.
Now, think about the mechanics. If it were just blind, indiscriminate liquidity inflating a bubble, we would see massive, inexplicable bubbles in low-margin industrials, legacy retail, and raw commodities. But we do not. The liquidity targeted the software and AI platforms specifically because the market is a highly sophisticated weighing machine. It recognized exactly where the actual durable high-margin cash flows were being generated and directed capital there. It wasn't an accident.
That defense assumes the market perfectly and accurately prices those durable cash flows without any narrative distortion. But even elite, highly profitable firms are subject to narrative bubbles, which brings us right back to Meta Part 2.
How so?
Your defense relies heavily on the idea that 40% margins somehow immunize these mega-cap firms from irrationality and brutal corrections. But Meta's $800 billion wipeout in 2022 unequivocally proves that when liquidity conditions tighten and duration assumptions outrun actual cash flow accountability, disaster strikes. Investors assumed Meta would grow at 20% indefinitely. When that duration assumption proved false, the penalty was catastrophic.
But they rebounded.
Yes, but the wipeout itself proves that even real, highly profitable, world-changing franchises suffer brutal repricing when the narrative breaks. The market is not perfectly efficient. It is prone to extreme bouts of behavioral extrapolation, consistently assigning permanent dominance to what are actually cyclical trends.
Okay, I think to truly understand this paradox, to bridge the immense gap between my defense of irrational technological repricing and your warnings of a pseudo-stable bubble, we have to look entirely outside traditional finance terminology. We cannot resolve this using just trailing PE ratios and M2 figures. Those are just symptoms. We need conceptual frameworks.
I'm listening.
I argue we are currently utilizing an outdated map. Imagine trying to navigate a modern, complex metropolis with its subways, high-speed rail, and multi-level highways, using a map drawn in the 19th century that only shows dirt roads and horse trails. That is what economists are doing today, using legacy Main Street indicators, manufacturing surveys, localized employment indices, rail car loadings, to navigate a fundamentally borderless, digital and AI-driven economy is useless. The territory itself has changed. Value is now intangible. It is encoded in algorithms, it lives in server farms, and it scales without borders. The map must be updated to reflect this new reality, not discarded as evidence of a massive delusion.
That is an elegant defense, but I counter your outdated map with a far more comprehensive and, frankly, more realistic framework, the ecological analogy. To truly understand the behavior of the S&P 500 and the broader economy, we must view it as a living ecosystem.
Like a literal forest.
Yes, imagine a vast, diverse forest. Over time, due to specific environmental conditions, in our case, zero interest rates and zero marginal cost software, a few keystone species begin to grow incredibly tall. Let's call them the top 5 mega-cap tech stocks. They grow so massive that they dominate the entire canopy.
And if you're flying over this forest in a helicopter, looking down at the canopy, which is exactly what looking at a cap-weighted index like the S&P 500 represents, the forest looks absolutely magnificent. It appears incredibly dense, lush, and thriving.
Yes, from the sky it looks perfect. But what happens if you land that helicopter and walk around beneath that canopy? The reality on the forest floor is incredibly bleak. The soil is becoming poorer, leached of all its essential nutrients and capital by the massive, deep roots of the giants.
The understory, representing the small businesses, the middle-class laborers, the regional banks, the Ohio robotics of the world, is thin, starving for sunlight and resources.
So the giants are literally starving the rest of the ecosystem?
Exactly. The ecosystem is experiencing what biologists call organizational entropy, the sheer amount of energy and capital required to maintain the complexity of these towering giants is starting to exceed the productive capacity of the real economy beneath it. It looks robust from the sky, but it is dangerously, structurally fragile. It has lost the biodiversity required to absorb exogenous shocks. A forest composed of essentially a single dominant species is a monoculture. It is highly efficient in perfect, sunny conditions, but a single specific pathogen, a severe drought, or a stray spark can incinerate the entire system because it completely lacks natural fire breaks and adaptive resilience.
That is a compelling, even poetic indictment of corporate concentration. I concede the visual power of the monoculture argument, but it leads us directly to the wild card of this entire debate, which is key analogy 3. The market is not the economy. We must dissect the hidden mechanical architecture that is actually driving this disconnect on a daily basis, and that architecture is passive investing.
The index funds.
Yes. The relentless flow of capital into passive index funds has fundamentally, mechanically altered market behavior. Think about how a cap-weighted index like the S&P 500 works. Success literally begets index weight. As a company's stock price rises due to strong earnings or narrative momentum, its percentage of the total index increases.
And this creates a blind, automated amplification loop.
Exactly. This increased weight automatically attracts a larger share of every single dollar invested by retirement accounts, 401ks, and institutional algorithms worldwide. When an everyday worker puts $500 into their retirement fund every 2 weeks, a massive percentage of that automatically buys the top 5 tech stocks, completely regardless of those companies' fundamental valuation or PE multiple at that exact moment. It is price-insensitive buying.
Precisely. The index is no longer a thermometer passively measuring average corporate health. It has become an active engine. It is an amplifier of concentration. This creates a reflexive loop where capital flows into the largest companies simply because they are already the largest. It pushes their valuations ever higher, artificially suppressing their cost of capital and simultaneously starving the rest of the market. The understory of our forest of investment.
And this brings us back to the starkest statistical contrast of our entire discussion. The mechanics of passive investing perfectly explain why the top 5 firms' share of the S&P 500 market cap climbed relentlessly from 10% in 2007 to roughly 25% in 2023, while simultaneously the underlying labor force participation rate deteriorated to 62.8%. The passive flows mechanically build the canopy, entirely ignorant of the withering understory. The algorithm doesn't care if the labor force is shrinking, it only cares about market capitalization weightings.
Which forces us toward a necessary synthesis. We have laid out 2 highly detailed, fundamentally opposed frameworks, but if we are to provide real insight, we must reconcile these views. I believe we can conclude that the current state of the global economy is neither pure delusion nor pure prophecy. What we are witnessing is a liquidity and concentration-driven partial repricing of a genuinely real technological shift.
The technology is real, but the price is distorted.
Right. The AI and software revolution is real, but the monetary environment has distorted its valuation. Crucially, this technological shift has moved far too fast and concentrated wealth far too narrowly for the broader physical economy to absorb it without severe structural fracturing.
The critical question then becomes, how does this resolve? How does gravity return to the system? How does this immense divergence reconcile itself over the next decade? I see 3 specific, highly distinct paths of convergence.
Walk us through them.
The first path is price correction. This is the meta-scenario from 2022 writ large across the entire index. Valuations simply fall violently to meet cash flow reality. This happens if liquidity suddenly tightens or if the timeline for monetizing AI stretches years further out than the market currently tolerates. The canopy collapses.
And the second path?
The second path is time. In this scenario, equity prices essentially trade sideways for a decade. The market experiences zero nominal growth, which allows the underlying corporate earnings and the broader economic fundamentals to slowly catch up and grow into their currently elevated, historically high multiples. It is a slow, grinding reconciliation.
That sounds painful, but survivable. What's the third?
The third path is narrowing. This is perhaps the most insidious scenario of all. The biggest tech firms remain structurally strong. They continue to compound their moats, generating massive cash flows. But the rest of the market and the broader real economy completely fail to keep up. In this scenario, headline indices become entirely uninformative, effectively divorcing from the nation's economic reality permanently. The market and the economy become two separate, non-intersecting realities.
If we are to navigate those three paths, whether as investors, policymakers, or simply citizens trying to understand the world, we must execute on a set of precise, practical implications. We cannot just theorize about monocultures, we must measure the forest. We have 7 practical implications that must be monitored.
Let's hit the first one.
Implication number 1. Track breadth, not just the headline index. Investors and policymakers must actively compare the top 10 index weight against median stock performance on a quarterly basis. Here is the mechanical logic. If the cap-weighted S&P 500 is hitting record highs, but the equal-weight S&P 500, where the smallest company has the exact same influence as the largest, is flat or declining, that divergence is a massive red flag. It mathematically proves the ecosystem is a monoculture, and the supposed market rally is actually just a handful of isolated megastocks masking widespread corporate stagnation.
But if we're talking about tracking the health of this ecosystem, we can't just look at stock tickers. We have to address the human element, which brings us to implication number 2. Compare index earnings growth to median wage growth. I call this the social fracture line.
That's a powerful term.
If corporate earnings for the megacaps continue to compound at 15 or 20% annually, while median wage gains for typical households lag inflation or stagnate materially over several quarters, the economic disconnect is not healing, it is widening. A society simply cannot indefinitely sustain a regime where capital returns infinitely outpace labor returns without triggering severe political or social instability that ultimately threatens capital itself. You will see regulatory crackdowns, antitrust legislation, or sweeping tax overhauls.
Exactly. The political reality eventually overrides the financial reality, which leads us to implication number 3. Watch financial conditions against small business credit access. The Federal Reserve might look at their models and declare that financial conditions are easing based on tight corporate bond spreads for mega-cap tech companies. But the relevant question is not whether capital is abundant in the aggregate. The question is who can actually access it.
The Ohio robotics problem.
Precisely. We must track whether easing macro financial conditions coincide with improved commercial lending rates and business formation for smaller regional firms. If small businesses are still facing prohibitively high borrowing costs or outright rejection, while tech monopolies can issue debt at near-sovereign rates, then liquidity is remaining trapped in Wall Street channels. It is failing entirely to irrigate the broader economic soil.
And to monitor that structural risk, we need implication number 4. Monitor concentration directly. This cannot be an afterthought on page 12 of a financial report. It must be front and center on every economic dashboard. We must continuously track the top 5 or top 10 share of index market cap.
The 10% to 25% shift?
Yes. The structural shift from a 10% concentration in 2007 to a 25% concentration in 2023 is not a trivial statistical anomaly. It represents a fundamental rewiring of market architecture. If this concentration continues to climb toward 30 or 35% while market breadth weakens, any claims of systemic resilience are dangerously overstated. The heavier the top canopy becomes, the more fragile the entire foundation.
Which requires implication number 5 for truly holistic analysis. Use valuation and participation metrics together. You cannot look at the stock market in isolation from the labor market. When you combine our opening statistical triad, a 190% Buffett Indicator and a 25.1 trailing PE ratio, with a stagnant 62.8% labor force participation rate, the narrative fundamentally shifts from bullish optimism to systemic alarm.
Because the leverage is unsupported.
Exactly. Elevated multiples are justifiable, perhaps even safe, when broad labor participation is steadily rising. A growing, highly productive workforce generating widespread income can support higher asset prices. But those exact same valuation multiples are lethal when paired with a stagnant or thinning productive base. It signals maximum financial leverage resting on minimum structural human support.
To track where that leverage is hiding, we need implication number 6, which requires an evolution in macroeconomic thinking. Treat private credit and shadow liquidity as primary macro variables. The staggering growth of global private credit assets from $0.3 trillion in 2017 to $1.5 trillion in 2023 indicates that a massive volume of corporate funding and the associated risk-taking is occurring completely off the traditional regulated banking grid.
Out of sight.
Right. Investors, central banks, and regulators must relentlessly track credit spreads, refinancing walls, and default stress within these opaque private channels. Because if a systemic shock occurs, a sudden spike in rates or a localized recession, the initial cracks and stress-induced contagion will likely trigger convergence in the opaque private credit markets long before it ever manifests in public equity headlines.
And finally, implication number 7, separate exceptional firms from the average narrative. We must stop discussing tech or AI as a single monolithic asset class. A company with a dominant, impenetrable moat, massive free cash flow, and a proven return on invested capital above 30% deserves to be analyzed under a completely different framework than a speculative software-as-a-service company trading at 20 times revenue with persistently negative cash flow.
Like the .com pets.coms versus the Amazons?
Exactly. The ultimate lesson of Meta's brutal $800 billion drawdown and subsequent rebound is that even genuine world-changing franchises are not immune to severe valuation resets when liquidity recedes. The wheat will be separated from the chaff violently.
The absolute core of this entire debate. We have agreed that absorption is critical. But if broad economic absorption is the key variable that determines whether this market holds its plateau or violently fractures, how can the real economy, specifically labor markets, everyday households, and small industrial firms, actually internalize these massive AI productivity gains when the technology itself is fundamentally designed to minimize or entirely eliminate human labor?
That is the existential friction of our era. If the very mechanism of productivity expansion relies on the purposeful destruction of broad-based payrolls, the system inevitably starves its own consumer base. Robots do not buy houses, algorithms do not buy groceries. The market's current strength is the product of an extraordinary concentration of technological power interacting with highly unstable elements, massive liquidity distortions, and historically weak economic absorption.
The reality is that the most important mistake any observer can make right now is to confuse a few compounding corporate balance sheets with the actual living condition of an entire society. The real disconnect is not Wall Street versus Main Street. It is a tiny elite set of winning firms being mistaken for the economy itself.
If value increasingly accrues to code, chips, data, and ecosystem control, rather than to broad payrolls and physical capital, then markets can remain stronger than Main Street sentiment for longer than historical analogies imply.
This is the research desk officially signing off.